Let us know more about the banking sector reforms, which includes Basel norms, risk management, and non-performing assets. The growth phase in Indian banking sector is important to understand the banking sector reforms. So in over 5 decades since independence, banking system in India has passed through distinct phases. The very first phase was evolutionary phase prior to 1950, foundation phase between 1950 to 1968, expansion phase 1968 to 1984, consolidation phase between the year 1984 to 1990, and reformatory phase since 1990. So the first phase of reforms was mainly directed towards the policy framework and the institutional framework. Change in policy framework consisted of reducing cash reserve ratio to the initial standard to have the statutory liquidity ratio, that is SLR, deregulation of interest rates, widening the scope of lending to priority sectors, and by linking the lending rates to the size of advances. Then came improving financial health so that there can be soundness of banking sector by prescribing prudential norms. Moreover, steps were undertaken towards a maintenance of NPAs. Then there is improvement of institutional framework. Such improvements have been achieved in three ways, that is recapitalization, creating a competitive environment, and strengthening the supervisory system. And the second phase of the reforms mainly directed towards strengthening the foundation of the banking sector in three ways. That is, they were mainly focused on the structure of the banking system, whereas earlier the services sector and the soundness of the sector was mainly focused on. So by reforming the structure of the banking industry, technological upgradation and human resource development were the three basic objectives to have the second phase reforms. Then came prudential regulation. It consists of two types, that is economic and prudential. So in the pre-reform era, that is before July 1991, RBI regulated banks by imposing various constraints and restrictions on interest rates. There was tightened entry norms, and there was directed lending to ensure judicious and in use of bank credit. But it hampered the productivity of bank and their efficiency as well. So RBI has to switch towards prudential regulation, which imposes bank with the minimum limit on the capital level to be maintained. On the basis of the recommendations of the Committee on Banking Sector Reforms in April 1988, the second Narasimham Committee, the RBI issued prudential norms. The major objective of setting such norms was to ensure financial safety, soundness, and solvency of banks. These norms are directed towards ensuring that banks carry on their operations as prudent entities so that they look out for losses first and then for the profits. So that in future if they incur any of the loss, they know they have backup at their place. And these are free from undue risk taking and do not violate banking regulations in the pursuit of profit. Committee formation is very important to understand the banking sector reforms. So we'll know more about it. In view of economic liberalization and growing trend towards globalization, various banking sector reforms have been introduced in India to improve the operational efficiency and upgrade the health and financial soundness so that banks can meet international standards. Reforms in the banking sector were introduced on the basis of the recommendation of Narasimham Committee, which consists of first and second committee in the year 1991 and 98 respectively. Then there was Verma Committee in 1996, and in the year 1997 there was Khan Committee. So all these committees recommended the reforms. We'll know more about Narasimham Committee in the year 1991, which consisted of the very first phase. It suggested acts and reforms for an improved banking system. It was formed right after the economic crisis. It suggested autonomy in banking, reforms in the role of RBI, change in CRR and SLR, recovery of debts, freedom of operation, area banks, prudential norms, and entry of foreign banks. The second Narasimham Committee in the year 1998 consisted of the second phase, which was again headed by the same person, that is 13th Governor of RBI. This committee is an extension of the first one, and here the idea was to overview the reforms introduced after the first committee. After this committee, there were many other committees were formed, which consisted of Verma, Khan, A.K. Butcher, Urjit Patel, and Bagal committees. Now, the second Narasimham Committee, which was formed in the year 1998, it suggested development finance institution to be formed and developed to have stronger banking system. There was an idea placed of non-performing assets, capital adequacy norms, tightening of provisioning norms, and rural and small industrial credits. We'll know about the importance of banking sector reforms and acts. Why these reforms and acts are important. These banking reforms aim to remove the external restrictions on banks like high interest rates, reserve requirements, and frequent changes in interest rate. They want to make the banking system more adaptive and flexible. They are to smoothen the process of banking information in India to promote healthy competition for better productivity. FDI is another area where they focus on to improve the economy. Merging of banks across India is again the focus. It is done to improve the efficiency and productivity. The reforms have improved the overall functioning of the banking system in the country. Main focus of reforms was in three areas, that is non-performing assets, capital adequacy norms, and diversification of operations. NPA is the very first part of the reform, which consisted of a non-performing asset. It is a loan or advance for which the principal or interest payment remained overdue for a period of 90 days. When you do not pay the principal amount or the interest payment for over 90 days, then that particular asset is termed as non-performing asset because it is overdue for a period of 90 days and that asset is not able to repay the amount of the loan. So it is not performing. Banks are required to classify NPAs further into substandard, doubtful, and loss assets. So here is an image which shows the classification of assets on the basis of their provisions and types. So standard asset consists of 0.25% of all types of standard advances, substandard 10%. Doubtful assets are those which up to 1 year, which are doubtful up to 1 year, and the provision for them is 100% of unsecured advances and 20% of secured advances. For 1 to 3 years, it is 100% and 30%. For more than 3 years, it is 100% of both secured and unsecured advances. And loss assets are those which have the provision of 100% of unsecured as well as secured advances. Gross NPA of scheduled commercial banks increased in the period March 31st, 1998 to March 31st, 2002 from 5815 crores to 7904 crores, that is 50,815 to 70,904 crores. Gross NPA of public sector banks were also correspondingly higher. So this was a sign of improvement. However, the share of PSBs in total NPA declined from 90 to 80%. Gross and net NPAs as a proportion of gross advances and total assets of scheduled commercial banks also declined substantially. So furthermore, there was decline in the gross NPAs and net NPAs as a percentage of advances as well as assets. The ratios present the quality of bank assets, so they must be maintained. But here everything was declining in nature because these ratios represent the soundness of the banking system. Next came in the picture is the Basel Accord. The Basel Accords refer to the Banking Supervision Accords recommendation on banking regulation. They basically recommend the banking regulation. So for that, the Basel Committee on Banking Supervision has issued 3 Basel norms, that is Basel 1, Basel 2 and Basel 3. They are called as Basel Accords as the BCBS maintains its secretariat at the Bank for International Settlements in Basel, Switzerland. The committee normally meets there and the Basel Accords is a set of recommendations for regulations in the banking industry. Here is a picture which shows you the Basel 3 structure in which the Pillar 1 consisted of capital risk coverage and containing leverage. Pillar 2 mainly consisted of risk management and supervision. Pillar 3 was of market discipline. And last we have liquidity, which consists of global liquidity standard and supervisory monitoring. The Basel IV standards are changes to global bank capital requirements that were agreed in 2017 and are due for implementation in January 2023 due to COVID-19 pandemic. Basel IV introduces changes that the limit which limits the reduction in capital that can result from the bank's use of internal models under the internal ratings based approach. We have standardized approach and internal ratings based approach. So it uses the internal ratings based approach, which includes a standardized floor so that the capital requirement will always be at least 72.5% of the requirement under the standardized approach. simultaneous reduction in standardized risk weights for low-risk mortgage loans, higher leverage ratio for global systemically important banks, that is GSIBs, with an increase equal to 50% of the risk-adjusted capital ratio. More detailed disclosure of reserves and other financial statistics is also included in that. Next in line we have is capital adequacy ratio, the second important point. In 1988, the Basel Committee for International Banking Supervision made an attempt worldwide to reduce the number of bank failures by tying a bank's CAR to the riskiness of the loans it makes. So the risk and the number of bank failures, so it was basically combined. So the bank's CAR and the risk it takes were tied to know that why the banks are failing, so that we can reduce the number of the failures. CAR is a measure of the amount of a bank's expressed capital in the percentage form of its risk-weighted credit exposures. So bank's capital in percentage upon risk-weighted credit. High capital adequacy will improve the efficiency of the banks in two ways, that is by forcing banks to reduce operation cost and by improving long-term viability through risk reduction. It enables banks to mobilize more capital at reasonable cost. On the basis of Basel Committee proposals in 1988, two tiers of capital have been prescribed. So the very first consisted of capital which can absorb losses without forcing a bank to stop trading, and second one which will force trading to cease, that is in the event of a winding up of a bank. Following recommendations were there of the Narasimham Committee, which was the very first committee. So it recommended that the RBI direct the banks to maintain a minimum capital of 8% as risk-weighted assets. Second committee suggested raising the ratio further, that is from 8 to another level. Then at the end of March 2002, all scheduled commercial banks except the 5 had CRARs, that is capital adequacy ratios requirement in the excess of the stipulated 9%. The capital of public sector banks has increased through government capital infusion, equity issues of public and retained earnings. Next in line we have diversification in bank operations. During the period of economic liberalization, public sector banks have diversified considerably. So they have moved into new areas, like now the banking operations are at the expansion stage where they are expanding their branches as well as they are diversifying their operations. They are providing a variety of services which included mutual funds, merchant banking, venture capital funding, and other parabanking activities such as leasing and lease financing, hire purchase, factoring, and so on. So that was basically diversification of their operations. Main objective was here to make profit by deriving maximum economies of scale and scope, enlarging customer base and providing various types of banking services under one umbrella. A single bank is providing you multiple services, both directly and also through subsidiaries. Many banks such as SBI have become a one-stop financial service center. Other important reforms included institutional and legal measures, supervisory measures, competition enhancing measures, measures enhancing role of market forces, and technological measures. We'll discuss them one by one. Institutional and legal measures mainly consisted of setting up of local adalats and debt recovery tribunals, asset reconstruction companies, settlement advisory committees, corporate debt restructuring mechanism, so that they can have quicker recovery and restructuring. There was promulgation of Sarfazi Act and its subsequent amendment to ensure creditors' rights, setting up of Credit Information Bureau for information sharing of defaulters and also other borrowers, setting up of Clearing Corporation of India Limited, that is CCIL, to act as central counterparty for facilitating payments and settlement system relating to fixed income securities and money market instruments. In the supervisory measures, there was an establishment of Board for Financial Supervision as the apex supervisory authority for commercial banks, financial institutions, and NBFCs as well. Introduction of CAMEL supervisory rating system was important here. It was a move towards risk-based supervision, consolidated supervision of financial conglomerates, and strengthening of off-site surveillance through controlled returns. Then there was recasting of the role of statutory auditors, increased internal control through strengthening of internal audit. Then there was strengthening corporate governance, enhanced due diligence on important shareholders, fit and proper test for directors as well. So all these measures were for regulation and supervision purposes, so that the banks and the financial institutions run efficiently. It also consisted of NBFCs as well. Next, we have measures enhancing role of market forces. We'll see what happened in the market forces. So there was sharp reduction in preemption through reserve requirement, market determined pricing for government securities, disbanding of administered interest rates with a few exceptions, enhanced transparency and disclosure norms to facilitate market discipline, introduction of pure interbank call money market, auction-based repos and reverse repos for short-term liquidity management, that is short-term interest rates, facilitation of improved payments and settlement mechanism was important here. In the competition enhancing measures, there was granting of operational autonomy to PSBs, reduction of public ownership in public sector banks by allowing them to raise capital from equity market up to 49% of the paid up capital. So now the public sector banks can raise capital up to 49% from equity market. Transparent norms for entry of Indian private sector, foreign and joint venture banks and insurance companies, permission for foreign investment in the financial sector in the form of FDI as well as portfolio investment, permission to banks to diversify their product portfolio and business activities. Technology related measures mainly consisted of providing services based on technology, that is setting up of Infinet as the communication backbone for the financial sector, introduction of NDS, that is negotiated dealing system for screen-based trading in government securities, and real-time gross settlement RTGS for payment settlement. Risk management mainly consisted of all the reforms, how these reforms manage risk. So it includes bits of each type of reform. So RBI in 1999 recognized the need for an appropriate risk management and issued guidelines for the same regarding asset liability management, management of credit, market and operational risk. Objectives here were, the very first was to reduce the level of risk to which bank creditors were exposed, that is prudential norms to protect the depositors, systematic risk reduction to reduce the risk of disruption resulting from adverse trading conditions for banks causing multiple or major bank failures, avoid misuse of banks so that it can reduce the risk of banks from being used for criminal purposes, to protect banking confidentiality, and have credit allocation to direct credit to favored sectors. So these were the main objectives of risk management. Here is an image which shows major banking sector reforms and acts in India. There are more than 70 plus acts and reforms. So right now we have the question and answer section. So I hope you understood the video and you'll answer both these questions in the comment section. The very first is committee was formed in the year 1991. There were two committees. First committee was formed in the year 1991 and the second was formed in the year 1998. If you know both, do answer them in the comment section. The second question for the day is, the Basel Committee on Banking Supervision maintains its secretariat at the banks for international settlements in dash. You have to name the place in Switzerland. I hope you learned a lot through this video. Stay tuned for more such videos.